Welcome. This video is the solution to the monthly challenge from TechHub.training. During this video, I will go over each of the earnings management tests you were asked to calculate in the challenge. These tests include valuation multiples, inventory growth and turnover, sales growth, collections periods, allowance for doubtful accounts, accruals, and the Benish model. So starting with the first tab and company data, we have the information for the current year and previous year information for each of the 10 companies. And this is all we will need to run our tests. The second tab for analysis is where we will conduct them. So starting off with valuation multiples, this is just the share price divided by the earnings per share. And then price to book is the share price divided by the book value per share. And then drag that down. And we will then apply conditional formatting, the color scale, green, yellow, red. We do it in different, we do each column differently because they're on different scales. So here we see that company 3 stands out with having a very high valuation compared to the other 9 companies. The next test is inventory growth and days inventory held. Inventory growth is the current inventory minus the previous year divided by the previous year. Days inventory held is inventory divided by the cost of goods sold times the number of days in the period, which is 365. And then we can do the same thing for the previous year. And then drag these formulas down. Inventory growth will be on its own conditional formatting, and we will do red, yellow, green because we don't want too high of an inventory growth. This can reference either slowing down in sales or that they just can't turn over much of that inventory, or even stuffing into those accounts rather than expenses. And then the days inventory held, we will apply formatting to those together. Sales growth is the current sales divided by subtracting the previous sales divided by the previous sales. And then inventory growth we already calculated in the previous test, and we can just reference it there. Sales growth is good, so we'll do the green, yellow, red scale, and inventory growth we will stick with red. Next is AR growth. It's calculated the same way. Oh, I forgot to mention, net accounts receivable is something we have to calculate first. Net accounts receivable is the gross accounts receivable for each company minus their allowance for doubtful accounts. The likelihood that these accounts they won't be able to collect money on, and so we only want the net information for growth. So we do net accounts receivable minus the previous year divided by the previous year. And then days sales outstanding is net accounts receivable divided by sales times 365 days. Drag that over and then drag these down. AR growth is also not too desirable, so we'll apply the red conditional formatting along with days sales outstanding. Next is allowance for doubtful accounts, and we want to calculate that as a percentage of net accounts receivable. So that is just the allowance divided by the net accounts receivable, and we can just drag that over and drag these down. These are on the same scale, so we can do the conditional formatting on them together, and we will apply red, yellow, green because a high allowance is a more conservative and realistic number. Next is accruals to assets. As you saw in the instructions, accruals are the difference between net income and operating cash. And then we want to divide that by total assets to get the ratio. Having a high percentage of accruals is not a great indicator. It's kind of hard to say without reference, but we will apply the red, yellow, green to that. And then lastly is the Benish model. So seeing these previous tests, we see that company 3 is usually the one that stands out with no allowance for doubtful accounts, high accruals, high net accounts receivable growth, high inventory growth, a low inventory turnover, yet it has a very high valuation, at least for its share price. And so that is something that we can consider for earnings management. So the last test we'll run is the Benish model. So in columns B through I, we will calculate the formula for each of the different variables. And then in the M-score column, we'll apply that to the Benish model formula, where we times each variable by its coefficient and then add them all together. So starting with this, it is the days of sales in receivable index. And this is calculated as net receivables of the current year divided by sales over the previous year. So we have net receivable, so we'll have to do the accounts receivable gross minus allowance divided by sales, and then all of that over the previous year's accounts receivable gross minus the allowance divided by sales. Let's see. Oh, reference that twice. There we go. Next is the gross margin index, which is the previous year's gross margin divided by sales divided by the current year. So go back to company data, and we'll have sales divided by cost of goods sold. Sorry, subtracting cost of goods sold divided by sales. All of that over sales minus cost of goods sold divided by sales. Next is the asset quality index, which is non-current assets minus PP&E over total assets for the current year divided by the previous year. So we get non-current assets, subtract PP&E, divided by total assets. Next is the sales growth index, which is just current sales divided by previous year sales. Next, we have the depreciation index, which is the previous year's depreciation divided by PP&E plus depreciation divided by the current year. So we get the depreciation expense divided by depreciation plus PP&E divided by depreciation expense divided by depreciation expense plus PP&E. Next, we have the SG&A expense index, which is the SG&A expense of the current year divided by sales divided by the previous year. Next, we have the leverage index, which is total debt divided by total assets divided by the previous year. And then lastly is the total accruals to total assets index. And this is something we calculated earlier, which is total accruals divided by total assets. And so we already know how to do that. It is net income minus operating cash divided by total assets. So we've calculated the 8 factors for the Benish model, and now we will apply them into the M-score formula. So the first is a y-intercept of negative 4.84 plus 0.92 times the DSRI plus 0.528 times the GMI plus 0.404 times the AQI plus 0.892 times the SGI plus 0.115 times the depreciation index minus 0.172 times the SG&A index minus 0.327 times the leverage index plus 4.679 times the total accruals to total assets. And if you run that through, you get negative 2.3. And so the M score, as long as it is under negative 1.78, we can expect a normal valuation and not too much earnings management. Anything above, we can expect that the company is likely to be a manipulator. So we will copy this down for all 10 companies and then use a conditional formatting. And since a high number is bad, we will do red, yellow, green. And again, we see that company 3 has a high M score and is likely to be a manipulator for earnings management. All right, thank you for watching.